For much of the last decade, conservative financial models fell out of favor across American businesses. Companies were encouraged to be bold, assume rapid growth, and use cheap capital to scale quickly. Optimistic projections, aggressive leverage, and thin margins were often justified by the promise of future dominance. In 2026, that mindset has clearly reversed. Conservative financial models are making a strong comeback, and this return reflects a fundamental shift in how U.S. businesses. This change is not about fear or a lack of ambition, it is about realism shaped by experience. Years of economic shocks, sudden demand shifts, rising interest rates, and unpredictable costs have exposed how fragile aggressive financial assumptions can be. Companies that relied on best case scenarios found themselves forced into painful corrections when conditions changed. Conservative financial models are returning because they reduce surprise, protect control, and support long-term stability. At the heart of conservative financial modeling is a change in assumptions. Instead of projecting strong growth by default, businesses are building plans around moderate or uneven growth. Revenue forecasts are stress-tested against slower demand, customer churn, and pricing pressure. The goal is no longer to model what could happen under ideal conditions, but what is likely to hold up under realistic ones. Interest rates have played a major role in accelerating this shift. When capital was cheap, leverage amplified returns and masked financial weakness. Today, higher borrowing costs magnify mistakes. Conservative models place much greater emphasis on debt service, cash flow coverage, and balance sheet resilience. Companies are far less willing to rely on refinancing or future capital raises to support current operations. Financial independence has become a strategic priority. Cost assumptions have also changed dramatically. Conservative models now assume that costs will rise, not fall. Inflation, compliance requirements, cybersecurity spending, technology maintenance, and labor costs are treated as ongoing realities rather than temporary spikes. This prevents companies from underestimating expenses and building strategies that collapse when costs normalize at higher levels. Cash flow has moved to the center of financial planning. In the past, income statement growth often dominated discussions. Today, conservative models focus heavily on when cash is received and when it is spent. Liquidity, working capital needs, and timing mismatches receive more attention than headline profitability. Companies want to avoid situations where they appear profitable on paper but lack the cash to operate smoothly. Capital allocation decisions reflect this new discipline. Projects are evaluated using stricter return thresholds and clearer downside analysis. Investments that only make sense under optimistic assumptions are increasingly delayed or rejected. Conservative models favor projects that improve efficiency, reduce risk, or generate steady returns rather than those that promise explosive growth with high uncertainty. This approach has reshaped how companies think about expansion. Instead of entering new markets aggressively, businesses are expanding more selectively and in phases. Capital is released gradually, with performance milestones required before additional investment. This reduces the risk of overcommitting resources and allows companies to adjust if conditions shift. Conservative financial modeling has cooled enthusiasm for large, highly leveraged deals. Synergy assumptions are scrutinized more closely and downside scenarios are taken seriously. Companies are favoring smaller, strategic acquisitions that add predictable cash flow and integrate smoothly into existing operations. Investor expectations have reinforced the return of conservative models. Shareholders and lenders have become more skeptical of aggressive forecasts that repeatedly miss targets. Companies that consistently meet or slightly exceed conservative projections are rewarded with greater trust and lower volatility. Financial credibility has become an asset, not just a reporting outcome. Workforce planning has changed alongside financial modeling. Instead of hiring for projected growth, companies are aligning headcount with confirmed demand. Conservative models discourage building cost structures that require continuous expansion to remain sustainable. This reduces the likelihood of sudden layoffs and supports organizational stability. Technology investment follows the same logic. While companies continue to invest in AI, automation, and digital systems, conservative models assume longer timelines for returns and higher implementation costs. Spending is phased, and success is measured incrementally. This prevents technology initiatives from becoming financial burdens when adoption is slower than expected. Risk is no longer treated as a separate exercise from financial planning. Conservative models embed risk directly into assumptions. Companies ask not only how much they can earn, but how much they can absorb without losing control. Boards of directors have played a significant role in this return. Directors are demanding more conservative assumptions and greater transparency in financial plans. Strategies that rely on narrow success paths face greater scrutiny. Conservative models support better governance by making vulnerabilities visible early rather than hidden behind optimistic projections. There is also a cultural shift taking place. For years, conservative financial thinking was sometimes viewed as a lack of confidence. Today, it is increasingly seen as a sign of maturity. Leaders who prioritize resilience, liquidity, and disciplined assumptions are viewed as responsible stewards rather than cautious operators. Importantly, conservative financial models do not eliminate growth, they redefine it. Growth is pursued when it can be supported by cash flow, balance sheet strength, and operational capacity. Expansion is paced to avoid fragility. This may result in slower growth in some periods, but it greatly reduces the risk of sudden collapse when conditions change. Institutional memory has reinforced this behavior. Companies that experience severe stress during recent downturns have internalized the cost of optimistic planning. That experience has reshaped how finance teams, executives, and boards approach forecasting. Conservative models are seen as protection against repeating past mistakes. Regulatory pressure also contributes to this shift. Increased scrutiny around reporting, risk management, and financial stability encourages more realistic assumptions. Businesses know that regulators, auditors, and stakeholders are paying closer attention to financial credibility. In 2026, the return of conservative financial models reflects a broader evolution in American business strategy. Companies are no longer designing financial plans for perfect conditions. They are designing them for reality, a reality where volatility is persistent and flexibility matters more than speed. Conservative financial models provide clarity in uncertain environments. They support better capital allocation, stronger balance sheets, and calmer decision-making under pressure. They reduce the gap between expectations and outcomes, which builds trust internally and externally. This return is not a retreat from competitiveness. It is an adjustment to a more demanding environment. Businesses that adopt conservative models are not giving up on success. They are increasing the odds that success is sustainable. The return of conservative financial models in American businesses ultimately signals a shift in priorities. Stability now rivals growth. Discipline rivals ambition. In a business world shaped by constant uncertainty, conservative financial thinking has become not a limitation but a powerful competitive advantage.